To the moon! The SPAC and meme stock rallies have made this a crazy year. I'm going to pick one company out. Let's do this. So ticker UWMC, that's United Wholesale Mortgage. Now you might have heard of them recently because over the last few months they've had a lot of media attention. They were originally called United Shore Financial, and they came to light this year when they IPO'd via Spec Merger with Gores Holdings 4, which completed on the 22nd of January at a value of $16.1 billion, which at the time was the biggest SPAC merger ever. Since then, they've had more media attention thanks to Wall Street Bets, where it's been included in the list of meme stocks and given the stock a wild ride over the last year. Since the stock opened at $10, it's been up and down and is currently bouncing around $8, hurting anyone who bought into the original SPAC deal. Despite what's going on with the stock, I think the company is sound and deserves a second look, so I'm going to break down the details. UWM are a wholesale mortgage lender founded in 1986 who compete with retail mortgage sellers. They do this by funding and administrating the process of residential mortgage applications initiated by various mortgage brokers, banks and credit unions from all 50 states. It's not very often that people buy a home in their lifetime, and when they do, they tend to be more familiar with the retail mortgage sector due to the large profile they develop through advertising and big brand recognition. These retailers handle everything in-house and work directly with the home buyers. Mortgage wholesale lenders, such as UWM, don't work directly with the home buyer. Instead, they offer their products through mortgage brokers who are able to work with any mortgage provider to find the best rate for their customers. The wholesaler then underwrites and funds the loan. UWM's stance is that retail mortgage providers charge higher rates to cover the higher margins, namely their huge infrastructures, bloated staff numbers, marketing, etc. Whereas UWM use a number of modern technology tools to quickly and more effectively match borrowers to their ideal finance options, offering lower rates than their competitors due to having smaller margins. Despite the obvious benefits to customers, the wholesale market is only around 21% of the mortgage market overall, but UWM expect this to increase to 32% by 2025, at which point they predict their number one position in the wholesale market at 36% to increase to 45%. They plan to grow this position by acting as a partner for brokers, offering them a stronger product, excellent pricing and the best technology in the industry. And it's the technology that UWM consider to be the most important part of the business now and moving forward if they are to become the market leader. They offer a range of cloud-based software solutions to their clients, all designed to keep the application process as efficient as possible, minimizing time and costs. Blink Plus allows borrowers to complete an application easily and securely from anywhere at any time, with automatic credit pulling, e-signing of documents, and the ability for brokers to co-browse screens with their customers. It's effectively a point of sale and loan origination system and a customer relationship manager all in one package. Brand 360, a customizable client management tool that powers different marketing tools, from customized emails, videos to their customers, promoting events and even managing their social media presence. UWM In Touch, a mobile app that provides an easy and convenient way for mortgage brokers to access UWM's platform, organize contacts, oncoming business, lock a loan, check current rates, and more anytime from anywhere. You could even take a photo of a document and it will convert it to PDF. They also have various internal systems that quality checks applications and their internal processes to ensure that nothing moves forward unless all the checks and appropriate documents are uploaded. In particular, EaseDocs 2 helps brokers create Fed and state compliant mortgage packages. One of the key results from all this technology is that they can support a mortgage application time of just 17 days, beating the industry average time of 47 days. Given how much of a factor time can be in the home buying process, I think this is a key advantage to their customers. Additionally, UWM believe in the quality of their underwriting staff and have invested heavily into their training, ensuring each underwriter receives a 5-week training session followed by at least 2 weeks of mentoring. For the last quarter, they reported 457,000 training hours and have been ranked number 1 in the Training Magazine's Top 100 award. Also, the company's CEO, Matt Ishbia, claims to treat his staff like a family, and for their hard work, he's rewarded them with bonuses that include $25 million worth of bonuses, $35 million worth of company stock, 100 all-expenses paid trips to Miami, 10 2-year leases for Cadillacs or Corvettes, a year's worth of groceries, trips to anywhere in the USA, and a free home remodel. So it's no wonder that the company's been receiving around 300 job applications a day. And what this tells me is that the company is willing to invest a lot into keeping their staff, which means that given all the training hours they put into their staff, they're making a good investment for the company's future. And that brings us to the financials.
Let me see your war face.
So I want to start with the last 2 quarters because that will give us an understanding of how the company was performing before and after the SPAC deal. We can see that UWM declared some amazing year-on-year results. You can see that closed loan volume is up by 71.4%, loan production income up by 376%, but incredibly net income was up by 821%, cash was up 818%, and total equity was up by 259%, plus profit margin was up by 177%. Additionally, administrative costs have come down by 40% from $28 to $16.8 million. Commission and benefits have gone up by 138% from $89.4 to $213 million. Total expenses have come down by 29%, which is an excellent improvement for one quarter. The company currently reports Q1 this year as their best quarter ever. On the earnings report, the company declared that they have the capital, campus, and staffing necessary to further scale the business and become the largest mortgage lender in the country, and expect Q2 to reach 51 to 52 billion in closed loan volume. Now, it's one thing to be number 1 in the wholesale market, but trying to be number 1 in the retail market means taking on a multitude of different retail providers. This would require taking up to 50% of the retail market, which is very ambitious to say the least. However, Matt Ishbia wants to take that position by 2024. So how likely is this? To start with, I've compiled available information from previous reports. The closed loan volume seems to have reached an average of around $53 billion per quarter, and year-on-year growth seems to be heading in that direction. If we compare year-on-year change for each quarter, it shows us a growth in closed loan volume and cash, whereas total liabilities are improving, being down around $1.5 billion since last quarter, so the company is moving in the right direction. To compare with the competition, here are the retail market leaders by annual volume for 2019 and 2020. Some have lost their past positions over the year and fallen behind market leaders Rocket Mortgage and PennyMac Financials. UWM have taken 3rd position ahead of Wells Fargo, JP Morgan Chase and Bank of America, who seem to have lost significant volume. If we compare the top 3 competitors with their Q1 volumes, we can see that UWM is at 2nd place behind Rocket, who have double the volume, whilst PennyMac continues to underperform. It's positive to see UWM on the up, but they need to double their volumes if they have any chance of taking the number 1 spot from Rocket. Comparing these 3 simply on revenue and earnings, PennyMac is on a downward trend, UWM is volatile, and Rocket seems to have a really high revenue to deliver on some rather shallow earnings. Out of the three, I think UWM are showing the best earnings to revenue ratio. However, the quarter one earnings show a drop from the last quarter of $1.37 billion to $47.8 million, despite UWM declaring it as their best quarter ever. This doesn't seem to have gone down too well with investors, as the stock sank to $6.73 on the earnings release. On May the 11th, the company announced a $300 million share buyback program over the next 24 months, signifying confidence in the company and continued profitability, which helped drive the stock up to $10.24 in June, but it's been continuing on a downward trend to the current $8 mark ever since. This needs proper look, and it's a lot to do with how the Spec Merger was formed. If we look again at the quarter one financials, we can see that the net income of $860 million has been cut, with $812 million going to a non-controlling interest. This refers to the Spec Merger, and information on this can be found in the company's 10Q report. For the Spec Merger, UWM Holdings LLC joined with SFS Holding Corp under the Spec Gauls Holding 4. Under the deal, SFS Holding Corp, namely Matt Ishbia and his family, retained 94% of the economic and practical ownership of the company, and Gauls paid them a total of $912 million, which was invested into its various technology platform tools. In addition, Ishbia retains 100% of the Class D shares, which can be converted to Class A shares if certain performance targets are met, namely the stock reaching $13 to $19. In summary, the SPAC deal and the resulting UWM stock represents 6% of the business as Class A shares, and therefore only 6% of the earnings. Any investors who didn't read up on this would probably have been quite disappointed and perhaps upset by the drop in earnings on the last quarter. This type of share division isn't completely out of the ordinary, and in fact, Rocket has a similar setup where its Class A stock represents around 4% of its Class A shares, whereas Class D shares are around 62%. Given how the stock has been moving, it suggests that investors have not been responding well to this. Now that we understand more about the company financially, it just comes down to whether or not they are able to achieve their goals. Now I think it comes down to two things. There needs to be a significant increase in customers using brokers, or the retail market needs to shrink. Presently there are signs that the market is shrinking due to concerns over the Fed reporting increases in inflation as the country recovers from the pandemic. Interest rates are likely to be going up, which would have a profoundly negative effect on the mortgage market, making whatever remains even more competitive. However, one of UWM's strategies was to offer an ultimatum to 4,600 of their 12,000 brokers who also work with Rocket and Fairway Independent Mortgages, saying they could no longer continue to do so if they wanted to work with UWM, with a threat of a $50,000 fine if they did. Rocket claimed that this was an attempt to give UWM an advantage and the actions would be harmful to brokers and the consumer. As of March the 17th, 3,000, that's 65% of these, had agreed to the conditions, far below Matt Ishbia's expectations to enlist at least 80% to their side. It is the brokers and the consumers who decide who to do business with, and if the majority of them are sticking with UWM, then they must see it as a superior product. Also, people need mortgages to buy a home regardless of the politics, so when the market is going to shrink and they're going to be looking around for the best deal, they're going to pick whichever company offers that. If UWM have the tools in place to give the best rates on the market, then they are in a prime position for any upcoming price war. So I'm going to go for the analytics and I'm going to explain why I think UWM makes the best choice at the top three. If we start with the share prices, Rocket Mortgages appears to have been on a rocket to the moon in March, before falling back down to earth, where all three seem to be experiencing some minor volatility. This table represents the analytical data I've gathered. The market average PE is 7.9, and going by the analytics, all have some good figures, with Rocket at 7.4, PennyMac just below 3, but UWM at an unbelievable 0.25 times earnings. UWM and PennyMac offer the greatest growth prospects, whereas Rocket may be about to see a downturn. PennyMac has some better analytics overall, but as we've already covered, their loan volume and earnings are on the decrease, and I'm not happy with the level of debt they are building each quarter. UWM have just provided a dividend of 10 cents a share, which matches the dividend from Wells Fargo, but their stock price is $45. Rocket doesn't even have a dividend, so you would be completely reliant on the company and the stock price growing, whereas what's going on with the market suggests that the retail market is actually on a slowdown, which is going to have a devastating effect on that company. Whereas UWM has more balanced fundamentals, and they've already been developing the tools and the network and relationship with their brokers to thrive in challenging market conditions. I think the SPAC acquisition and the negative media attention they've been having lately haven't done them any favours, but the biggest problem for UWM at the moment is the attention it's receiving from Wall Street bets, who have treated that as a meme stock, and I just don't think they need it. It's thrown UWM in with a group of failing businesses, irrational trading, and effectively causing investors to chuck the baby out with the bathwater. With Wall Street bets now setting their chat room to private, meme stocks are going to be even more unpredictable. And that means that I'd want to make sure that UWM stock is at the bottom of the Mariana Trench before I put anything big down. If it does shoot up again to stupid levels, I'm not going to chase it, as I think I'm likely to get burnt. I think the price at IPO at $10 was accurate given the numbers at the time, and the company has made some great gains since, but I think this year so far they have settled. Now, given the stock is trading under $10 at the moment, I'm going to keep buying, and I think my target price is around $12. So at $8 that gives me about 50% increase, and I'm happy with those numbers. That being said, I'm looking forward to the Q2 earnings report, because if the mortgage market is going to be as volatile as predicted and they're able to continue their growth or at least maintain their numbers, then I'm going to be further convinced by the strength of the company and their strategy, which means that I think they have a good chance of doubling their earnings next year and taking that number one spot away from Rocket. But whether that's ever reflected in the stock price is anyone's guess. So that's everything I have, and I appreciate you watching. If you have any thoughts, please comment below, let me know, and please consider subscribing. I put a lot of work into these videos and I want to keep doing them. Thank you.